Okay, where to enter exactly? And this was the big question that we had. Let the slider catch up here. All right, so this is the big question that we had, and the big question that was repeated over and over. So wanted to spend a bit more time on this. We're going to cover this section in the text format. Obviously, we'll go to the charts. The charts answer the questions better than I could ever type out in a PowerPoint. So first and foremost, question where exactly to enter. So the first thing we need to do is we need to understand where we are at in the current smart money trend. If you guys have been over the site, you know we're looking at the market cycle. The market tends to cycle in that 3-cycle pattern. So we need to first identify where we're at in the cycle, and you can write these things down. And if you're putting together a smart money trading plan, you should start with where are you at in the cycle. That should be your base first thing when setting up a trading plan based on trading the smart money cycle. So that's the first and foremost point. Now the second point here is you want to make sure you're within the 2 specific trading times, especially when you're learning the strategy. As you progress and become better, you can gradually yeah, I can. And I'm going to write something in as well in the announcement real quick. Sound, I'm sure, is there for everybody, but what I want to do is write in the announcement. Okay. So if you do lose sound, just go ahead and log out and then log back in, and you will have sound. So just want to note that at the beginning, because I'm sure other people will have issues. So if you're writing this down, I am going to leave it up for a little bit, and it's absolutely essential, especially when learning. As you become proficient, those that have become proficient and maintain profitability can start to venture outside, can start to do things that open up a few more avenues for taking trades based on the smart money trading strategy and the different criteria that we do look for. So first and foremost, identify where you're at in the trend. The second thing is make sure you're within the 2 specific trading times. The London session, and this, I do think that trades between 1:30 and 2 are viable, but just to be safe, we say 2 to 5 a.m. Eastern. If you don't understand what Eastern time is in relation to where you're at, go to Google, look at the world clock, and it'll tell you in relation to your specific time zone. The New York session, 8 to 11 a.m. Now, these are the 2 high probability times. We're going to discuss why we trade these times. So that brings us to the next point. Why do we trade at these times? What's so special about those times? Does the market not move between 5 and 8? Does it not move between 11 a.m. and 3 p.m.? Well, yes, it does, but again, it goes back to the question, why do we trade these times? And as new sessions come on, general order flow is processed that stacked up overnight. This is hence why we see manipulation during these high probability manipulation times. Now, what I mean by that, general order flow, is order flow that the banks have for worldwide commerce. Banks do not just move money for speculative trading. Speculative trading is a large portion of of the money that is moved. But if somebody is producing a product in the UK and they sell that product in the States and Australia and Canada, they're going to have to exchange Canadian dollars for pounds. They're going to have to exchange US dollars for pounds. They're going to have to exchange the Japanese yen for pounds. They're going to have to exchange all these other currencies for pounds, and that's what I term as general order flow, and that is processed through banks as well. So keep in mind what general order flow is. It's going to come into play as we progress through this webinar a bit. So at the beginning of sessions, this is when banks process the backed up general order flow that is backed up overnight or between the time that specific area's trading time is ended and when they begin their trading the next day, generally at 8 o'clock. So in that time where it's stacked up, you're going to come in and have a massive stack of orders. Now, the banks have 2 options. One is just to process that order, process the orders at the best price possible, and not have any care as to, as to how it will affect them or how it will affect the move. The other thing they can do is they can save orders for specific times of the day. Now that may, in generally that specific time of the day is in this first 3-hour time period. So the first 3-hour time period for London and the first 3-hour time period for the New York session. So what does that matter for us? Well, they use this money to manipulate the market. People will ask, and we'll cover this a bit more later, so we'll get a little redundancy here. But people ask, if smart money are going to, we talked about stop runs, or we will talk about stop runs. So if they're going to drive the price up because they ultimately want to sell into the buying pressure, or if they want to run the price up to hit the stops, which are going to be sell orders, and then thus buy into those selling orders, or whatever side they're going on, let's just say they're shorting the market. So if they're driving the market up into a resistance point and then past it, what's beyond most resistance points? Well, there's the buy order, which is a stop loss, and also the buy order for those buying in the breakout. And again, we're going to cover this multiple times, so if it's first time over for you, we're going to get a lot of redundancy. And we're also going to go through the questions, so we're going to hit this multiple times. So if they ultimately want to sell, but they know they have to drive the market up another 10, 15 pips to go hit the stops, the question is, how do they move the market up to go hit those stops? If they were just simply buying the market, wouldn't that defeat their original purpose, or their original intended purpose, which is ultimately to drive the market down? And so that's where this general order flow comes into play. If they know they're going to short the market for the day, they're going to process all those buy orders that come in the form of general order flow. That's going to begin to move the market up, which is going to move the market into the point they want, which is that high probability manipulation area. And again, we're going to cover this on the charts, and it will all come together. So they're using that general order flow to move the market into those high probability manipulation areas. So they're going to move it to push the market above highs, or to push the market below a low. As they push above a high or below a low, they collect the stops and thus trend the market in their direction. The reason it's pushed through at the beginning of the day is because that's when they start their trends. Therefore, they're going to manipulate before they start their trends. So again, that second point, make sure you're within the 2 specific trading times. That's very important, especially when just starting out. Third point here, identify the highest probability manipulation areas. Now, one thing we don't have is we don't have access to orders, meaning we don't have access to where the true volume is sitting. One thing we do know is how retail traders generally trade, and how retail traders on average place their stops. Now, we're going to cover this again more fully in this section as well in the charts. But what we do on a daily basis in the member section of the site, we do a 15-minute daily market review in a video format, and I not only say what the expected direction of the market is the following day, but I also discuss exactly where I expect the market to start from. And those manipulation areas are very often hit. We'll discuss some that have, some of the points we were talking about recently, and those manipulation areas are very frequently hit. And it's not, it's not some magic crystal ball that I have. It's not some, something that everybody else can't do. It's just a very simple question that I ask myself every day based on extremely common trading strategies and ways of placing stops. Where are the retail orders going to be? And by answering that one question and answering where the mass of the retail orders are going to be, this allows us to determine where the banks are going to go to manipulate the price. The banks are going to go after the orders. While we can't track the banks directly, what we can do is track where the retail traders are going. If we know where the retail traders are going, and then we see the manipulation at these high probability areas, that in itself tells us where the banks are, or where the banks are going. And again, will become more visually clear as we progress. Okay, so the fourth point here. Third point again, wait for the high probability manipulation areas. We'll discuss what those are coming up. Fourth point, wait for candle confirmation before taking a trade. And this specific point is more directly guided towards the original question, which is where exactly to enter. Hang on, guys. Let me take a quick drink. Okay. So again, this relates more precisely to where exactly to enter. And so the fourth point is wait for candle confirmation before taking a trade. Everyone has a different comfort level. One person may like another. What one person may like, another may not. And so what I mean by this is different people have different ways of taking trades, or different criteria that is going to actually signal the trade, different things that may filter out a trade, et cetera, when it comes to actually placing the trade. Now, personally, one thing that I prefer is I prefer the confirmation entry. It allows for a tight stop, which equals a better risk reward, which is extremely critical. In fact, if not one of the most critical parts to whether or not somebody's going to be a profitable trader. Additionally, the confirming entry tends to be safer as you are making the market show it is reversing before the entry. You know, you're not just taking it as it comes into a level. You're not just taking it once you see, you know, a slight sign of reversal. You're actually seeing, in the case of using 15-minute charts, you're seeing 30 minutes of visual reversal before the entry is taken. The great part about the confirming entry, however, is that, like I said, it allows for a tight stop. Most of the time, you will trade confirmation for you'll trade confirmation for entry point. And what I mean by that is the more confirmation you wait for, generally the worse entry you get. The beauty of the confirming entry is that not only do you get added confirmation, but you also get a very tight risk reward. Now, does this mean that sometimes you'll miss a trade because you don't see it setting up this way? Yes, of course. It does. But when it does come together, which is much more often than it doesn't, it gives you not only the tight stop, but also the added confirmation. We're going to fully cover all that, Krim. Yeah, I'll take trades that aren't based on the confirming entry. We'll get into that more specifically. So let's go through these slides and we'll get into that a bit more specific. As I said before, I'm going to try and really, you know, I don't want my part to take up a huge amount of time. I don't want it to take up, you know, an hour. We're at 23 minutes. I'm going to probably go for another 10 or 15, and then we'll try to. I'm a little bit long-winded, but then we'll go to questions and field all your guys' questions before we head out. Let's move on to point 3 here. As soon as the slide wants to go. Come on. All right, the confirming entry. Just catch up. It's important to remember that everything else must occur before taking a confirming entry. And that's, you know, all the other parts we talked about in the other slide. Market cycle, time of day, high probability manipulation point, etc. Without everything else preceding it, it is simply a candle pattern, and we don't trade candle patterns. We're not candle pattern traders. We're not chart pattern traders. Without everything else behind it, it means nothing. You're going to see it 1,000 times throughout the day. Where it becomes important is when you have an understanding of the full smart money strategy, when you understand market cycle, when you've identified that you're taking a trade in the direction of the market cycle, when you've identified that you're within the high probability manipulation times, 2 to 5 a.m., 9 to 11 a.m., and when you've picked out the highest probability manipulation point, then and only then, when you see the stop run pattern at that point, at that exact point, you see the stop run topping formation at that point, which we'll cover that more fully as well, then it becomes important. Without that criteria, it is simply a candle pattern, and we aren't candle pattern traders. You all have probably tried strategies that rely on trading candle patterns, and I'm going to venture to guess that 95% would all show the same thing in their account after trading a candle pattern strategy. Over the course of time, they just don't pay off, and that's I'm sure there's exceptions to the rule. I'm positive there are. For the vast majority, they never can make candle patterns work, and that's because a simple candle pattern is not enough to take a trade, in my opinion. Preferably, the confirming entry is created over the course of 3 candles. The entry is generally taken on the 3rd candle. However, I will accept up to 5 candle confirming entries. This will all be perfectly clear here shortly. So does everybody have that wrote down if they want to write that down? Hopefully I can just move on here. 3 15-minute candles, correct, Miles? It's taken on the 3rd candle, so what that means is that the 1st candle closes, the 2nd candle closes, and once it hits the point of entry on the 3rd candle, that can be at the beginning of the 3rd candle or sometime during the end, the entry is taken. So again, that will be very clear here shortly. Moving on to the next point or the next slide here. I'm going to go through once we get to the series of questions. I'm going to go through those a little bit quicker. It's going to be a basic overview of those questions, then we're going to hit the charts, and then we'll hit your guys' questions. I'll go through what I've written down as, once we have a slide that pops up, we'll start going through it there. Want to go through it fairly quickly, and then we'll get on to your questions and the charts, which are the most important when it comes to everything else that we've talked about. So some of the other questions that I've had, we'll cover about 7 or 8 questions and go from there. First question here is, how often do these trades come around? A general good rule of thumb is, we'll get into that, Abdul. If you guys want to save your questions for the end, we'll after we go over the charts, we'll have a full question and answer section. So how often do these trades come around? In general, you're going to see 1 or 2 setups on a given day, and that's an average. Now, if you just trade the New York session, you may see on average 1 quality setup a day. It depends. There's days where there's 3 to 5. There's days where you may see 1 setup through both sessions. So it really depends. What we focus on is we focus on being as selective as possible and waiting for strictly the best points to enter. So selectivity is definitely a key. Second question that was a very, very common question we got was, do you use larger time frames to help determine bias? We use the 1-hour chart to help us determine the overall market cycle. This 1-hour chart gives us the best perspective of what we want to see. We want to see what's happened over the course of the last 3 or 5 days. Beyond that, it really doesn't matter based on what we're looking for. So the hourly chart gives us a great viewpoint and picture of the last 3 to 5 days, which is what we use to determine the overall market cycle. A third point we had was what we talked about with the entry. That was a key question that we had quite a bit. Fourth point here, how do you keep the confidence to stay in a trade? Now, the confidence to stay in a trade comes from understanding how the banks drive the market. The confidence to stay in a trade, comes from that complete understanding, and once you've already seen the setup, knowing that this setup is frequently going to pay off, and in general, knowing that these setups are high risk reward setups. Beyond that, the confidence comes from not over leveraging on a trade, and the confidence comes from getting a good entry on that specific trade. Beyond that, confidence comes with time, because you're not going to have confidence initially. What I mean by that is confidence, like everything else in this market, comes over the course of time. So that's an important thing to remember, but it comes from fully understanding, having your direct trade plan, knowing your exact trade plan, and sticking to that trade plan. So that's really the key when it comes to that. We'll go through to the, let's see here. I wanted to answer 1 or 2 more quick questions before we get into the charts here. We talked about general order flow in times. Okay, the last question we had that we got quite a bit, specific markers for banking activity. This was one of the questions that I wanted to cover. And the only true specific marker for banking activity is the stop run. Now, what I mean by that is that is the one thing that you can be assured of is telling you specifically somebody moving a massive amount of money is triggering the stops. And with a high degree of certainty, when you see a stop run, that's the point you know. We talk about how the market is driven in 3 cycles. It's not like the banks sit there and say, okay, we're in the first cycle, we got to run 2 more to the upside, or we've had the second push down. Well, we have to run the market down in the third push. The fact that the market has cycled, cycles in runs of 3 is something that's been around longer than anybody in this room has been alive. That's just the way the market cycles, plain and simple. So we can put 2 basic facts together. That's the way the market tends to cycle, and the banks run the market. So putting those 2 facts together, what do you have? Well, the banks tend to drive the market in 3 cycles. So yes, that's how they tend to do it. But is that giving you a specific signal that, okay, hey, the banks are entering at this point? No, that's a broad spectrum view. What gives you that specific reasoning is the fact that you've seen a stop run, you've seen some stop taking, or you've seen a false push, which gives you a strong indication that you're seeing the banks taking the stops and thus driving the market in the opposite direction. So I want to go to some charts here. And we're going to start with, I'm just pulling up the charts that I use for the room. So the charts are a bit marked up, but I think this is good because it'll give us a bit of an overview when it comes to, okay, so first things first, we're going to talk about going back to specific entries. And what we'll do is we'll talk about entries that we actually took, because I don't like the Monday morning quarterback things. If this isn't an entry I got a video on of us taking the entry, or if it's not a video that we actually didn't take in the live room, I tend to not really want to talk about it, because I like things that we actually did and we're doing in real time. So the first thing we're going to get into is we'll go back to, we talked about entries, and the one thing that we talked about with entries was the confirming entry, and that was the basic principle, the basic question that we get quite a bit of, and therefore it's something that I wanted to cover when looking at a trade here. So let's get into, let's see here. Okay, this was a trade that unfortunately I ended up taking a break-even trade on this. I have the entry for this trade, which will be posted to the site more than likely today. I'll try and get that posted a little later on today. It might be either today or tomorrow, but this was on the euro going back to the 25th of September. It's a 15-minute chart, and I'm going to shrink this down just a touch so you can see everything of the chart. That way I don't have to keep repeating what time frame it is. So you guys should have that view of the euro. Now, looking at the euro on the 25th, this was during the Asian session, and generally I'm in bed at this time. This is a trade where I was up. I think I was working on an email that we sent out, or that I sent out to the list, or working on something. But regardless, the first thing that we were looking at, I'm going to cover the New York session trade first, because it really really clarifies and hits every aspect. But the first thing that we had identified, and I'm zoomed out here so you can get the overall picture of where I'm at. During this day, what we had was the basic, had a basic first push down that was followed up the next day by the second push to the downside. Therefore, going into this day, which was around the 25th, 25th and 26th, we were looking for the third push to the downside. So that's the first basic point we're looking for. Are you in the direction of the overall market cycle? If you are in the direction of the overall market cycle, then are you within the high probability trading times? Are you within 2 to 5 o'clock, or are you within the 8 to 11 time frame? So looking at this trade here, we were in the direction of the overall smart money cycle, and we had just pushed above the previous highs. Now, this goes back to the third point in the first slide we talked about, which is identifying the high probability manipulation zones. Again, first thing, identify what level you are in, the overall smart money trend. Second point is make sure you're within those specific trading times, those two typical times where you see market reversals, you see manipulation. The third point is going to be making sure you're at a high probability manipulation zone, or you're seeing manipulation beyond that point. We use a lot of things for that. So the more factors we have coming together at one point, the better. ADR, daily pivot, 200 EMA, 60 EMA, previous major support and resistance, that's really a key point, is that level of psychological barrier, multiple things. And so the more things we have coming together at one specific point, the more we can be assured there's going to be a massing of retail orders at and around that point. Now, this level here was the last previous high. Let's just strip this down to very basic foundation. As the market comes back into this high in this taller rectangle box is the New York session. Your horizontal long boxes are marking the Asian session. So coming into this high, what's the average trader going to do? And what I'm going to do here is I'm going to get rid of this line. I'm going to change the property here to black and widen this out so you guys can see it. So as the market comes into this point, comes into that line, what's the average trader going to do? Now, you have two options, really. The first point is you have those that are looking to trade the breakout, those that are looking to trade this market to the upside if there is a break through that point. So if you have those that are looking to trade that break, what order is above that high? Well, that's a long order. Those that are looking to go long. The second type of trader that you have is you have those that are looking to short this at resistance. If somebody's shorting this level, where would they more than likely put their stop? Well, the average retail trader, because this is what everybody teaches, is putting your stop above the last high or below the last low. So above that last high, you're going to have the stops for anybody that's short. If you're short, what is your stop loss order? Is it not? Is as well a buy order. You have to buy your position back. Therefore, you have two types of buy orders above most resistance points. That's really a key principle, because one thing that we know is that if smart money wants to short the market, how are they going to short the market without people to buy their position from them? In other words, you can't sell something somebody else isn't willing to buy. Therefore, because of the massive amount of supply that they need, or the massive amount of demand they need or they have to drive the area into these larger areas of supply. That's essentially the basic breakdown of it. So they know there's going to be a massing of supply of buy orders above this resistance point. That's one basic criteria, just strictly looking at support and resistance in that broad spectrum basis. So as they come into that point, we see the first push through that. Now, as it starts to get rejected down, I'm considering this as a potential stop run through this level. And this is where the confirming entry comes into play. Now we're going to break down the confirming entry and what was actually the signal for the entry. Notice how we had everything else preceding this. We had the market trend, we had the time of day, we had a high probability area. It was the last major high we had. No doubt there was going to be stops and breakout orders above that point, as there are any, as there is any major support or resistance point, especially that day's low or that day's high. Very, very key points. A lot of orders on just on either side of those points. So what I consider as the first candle in the confirming entry setup, remember it's typically a 3-candle setup. So the first candle is going to be a reversal candle. The first candle is going to be some sign of reversal. And so what we see here is that we start to see the first sign of reversal. You see this nice pin bar. It's in the direction of the overall smart money trend. It's during the specific times that we look for, and it's as the market pushes through a previous high, and we know, again, there's orders beyond that high. Very common, very well-known thing that there's orders beyond a high and a low. Very not frequently used. So as we see the market push beyond that point, what I'm going to do is I've already identified everything else, so I'm going to say to myself, I want to start to see some sign of reversal. We get that sign of reversal. To me, that pen bar there is going to be what I call the first candle in the 3-candle setup. So I'll put a mark above that point. That's the first candle. Now, as the next candle opens up, the market very well could just continue to run through that point. You could just see a continued run through that point, at which point the trade, we'd have no trade on that setup. So what we want to see, and the criteria for the second candle, if it's going to give us the confirmation we need, which hence the name, the confirming entry, which is why I call the second candle the confirming candle. Now, in order for it to be a confirming candle, in order for this candle here to be the confirming candle, the only criteria I want to see it meet is I want to see it close below the body of that reversal candle. So the first candle is what I term as the reversal candle. I want to see it close below the body of that reversal candle. Did that close below the body of the reversal candle? Well, very clearly, this closed well below the body of that reversal candle, very bearish close. Therefore, these two candles have just given me the confirmation that I'm looking for. Now, this is where I've now waited for the confirmation, but as I look at this trade here, and this one may not be that bad, but if say I were to take a trade from the close of this candle, or maybe, somewhere in this area as that candle's closing, you have about 17 pips to the highs. Well, if you want to get your stop above that high plus, above that high by a few pips plus spread, you're going to have larger than a 20 pip stop. We don't want to use larger than a 20 pip stop. What we want to do is we want to wait for the third candle to give us a pullback. So remember how I said that sometimes it will take, I'll consider an entry up to the 5th candle. These first 2 candles have formed. The next candle here is the 3rd candle, and we're again just going in succession. The following candle, the 3rd candle there. So this following candle, this following slightly bullish candle, is the 4th candle. Note, and the entry for the confirming entry is taken anytime after the second candle is closed. And the very basic criteria for the 3rd candle entry is we're taking the entry when that 3rd, or in this case the 4th candle, pulls back to and touches the body of that reversal candle. So what we want to see is let me delete this line here. We want to see the 3rd candle pull back, and as soon as, one good criteria for taking the entry is as soon as it touches the body of that reversal candle, that's where we're taking the trade. So let's go up to another illustration here, and we'll mark this all out. We'll discuss how this trade worked out ultimately here in a second. But let's go over here and see another confirming entry. So market comes back up to these highs, and I'll note how this trade worked out, because it's important to note why that pullback is so important. So again, we see another reversal candle. Does the next candle fulfill the criteria of a confirming candle? Does it close below the body of that reversal candle? Yes, it does. And then the 3rd candle opens up. Mark this out. And if you notice on that 3rd candle, it gives you a pullback. It pulls back into, and I'm going to wrap these lines essentially around the body of that candle. Actually, let me draw a line here, be a little bit clearer. So we'll just wrap these lines around that candle. This candle here, notice how that third candle pulls back into the body of that reversal candle. This is why I don't force trades. This is why if I don't get the pullback, I don't take it. If you notice at almost every key turning point, you'll get your reversal candle, you'll get your confirming candle, and then later, the third or the fourth candle will pull back into the body of that reversal candle. Just that basic tip right there would increase your edge tremendously. It can take a risk reward of 1-to-1 and very quickly get it to 2-to-1. Because not only are you're not only getting a better entry, which allows you to do what? It allows you to shrink your stop, which makes for a much better risk reward. So as we look at this trade, and I'll get into moving this over here. So we had the first candle close, second candle closed. We took the entry on the third candle here, and I believe we actually pretty well got it right at the highs. I believe our entry was 52 or 53. Anybody in the room, if you remember that trade exactly, can let me know. Now, I ended up taking a 10-pip loss in this trade, and I'll get into why. Generally, a pretty hard set rule I have is once I get into a trade, if I'm within that trade or if I'm in that any trade, I do not close the trade until the stop loss or the take profit is hit. I don't close manually. Now, in general, if I'm outside of the trading time and say the market has not moved, has not shown any progression, then I will exit a trade. Now, in this case, unfortunately, we had Draghi talking. Now, if you guys remember, 4 or 5 years ago, we didn't have the things we have now. Even 2 or 3 years ago, tape bombs were not such a massive part of the market. And so for me, one of the things, if you guys listen to Draghi speeches or you keep up with the news, you'll understand that Draghi, like any good central bank, any good head of any central bank is going to do, he's going to prop up a currency. So when Draghi was still speaking, to me, I think that opened up a lot of risk. And as I said in the room, it's a great setup. I take it every single time. And outside of, and if Draghi were not speaking, I would never close this trade ever with it before a take profit or a stop loss is hit. Or, I've sat there for 5 hours and we're at the end of the day. Outside of that, I wouldn't trade it because I love the setup. But considering the risk of Draghi speaking, I was taking the exit on that trade. Now, those that stayed in, obviously the 2-to-1 take profit was hit very easily. And with an entry, I think my entry was a little worse than yours, Wally. I got 53, if I remember correctly. And you see what an entry of 53 is going to do. 53, and we're going to go up. We're going to go up 20 pips here. We'll set 20 pips. 20 pips is right at 29.73. So throw a line at 73. Now the high of this one got to 70. Now nobody has a 3-pip spread on the euro dollar. If you do, you need a new broker. Even all the bucket shops in the U.S. during the New York session never have 3-pip spreads. So taking the entry on the pullback here was the difference between getting stopped out and having a great trade. And that's why just that small 5-10 pip pullback is a very, very key point. Another way to take the entry is after you see the first candle and the second candle set up, again with all the other criteria beforehand satisfied. A general rule of thumb is you can if you're waiting on the third candle pullback, in this case it was the fourth candle. So if you're waiting for that pullback and you want to use a 20 pip stop, you let the market pull back enough to where 20 pips from that entry point gets you a couple pips plus the spread above that high. And really, any way you do it, those are 2 ways that are frequently used by the members and by myself as well. And so whatever you do in that situation is really up to you, and it's it depends on your trading personality. Regardless, if you're setting your stop above the stop run, typically that stop run high or that stop run low will hold. I prefer, just as a general rule of thumb, I prefer to take the entry when it comes back and touches the body of the candle at that reversal point. So, or the number one candle, the reversal candle. In this case, we'll mark that one there. You can see, so whenever it comes back into that body or into the body here. Now, that's a personal thing. That's how I like to do it. The confirming entry has been widely successful with members who are looking to increase their risk reward and members that are looking to, number one, just get better entries. And that waiting for that pullback dramatically helps in decreasing your risk and increasing the potential profit. So getting into a counter trend trade here that I took a little bit earlier, this one was a live room trade. This one was a trade from earlier that day. I just finished up the daily market review for the members, and I saw the market, we'll go out here. I saw the market had just broken beyond the previous lows in a beautiful pen bar, just broken below those lows. So keep in mind these lows. I'm going to zoom in here a bit. It had just broken below those lows and got rejected back up with an absolutely beautiful pen bar there. And a good rule of thumb that I'll use is if you have a wide pen bar like this, one of the things that I like to use is a very, very simple rule. It's the exact same principle. In fact, the second candle here did confirm up. But because this wick was so long, one of the things I'll do when I get such a long wick is I will wait for the market to pull back half of that pen bar. Very, very simple. That's a 20 pip pen bar, or in this case, nice hammer formation, maybe not quite a perfect hammer, but the halfway point was right at 28.94. So as I bring the marker down here, we change this property over to a red one to mark the entry. And I'll get this video up on the site. You'll see it in the recent trades section. I have the entry from this trade. But as it pulled back into the halfway point there, that's where I was taking the entry. Now what that does from my entry point, 20 pips got me, to the low, I was only 9 pips away. So 20 pips got me well beyond the stop run. A very basic rule, placing your stop beyond a previous high or below a previous low, although it is the most taught thing. They teach you that when adjusting your stops, when trailing your stops. They tell you to trail it beyond the last high, trail it beyond the last low. That's where smart money goes to find the order. So why would we want to have our stops there? A good rule of thumb you can use is place your stop beyond the last stop run. So if you've identified something as the stop run, generally, if you put it beyond that point, they're not going to come get the stops again. And the rule behind that is it takes money to move the market. So it costs them money to move that market, or they had to use up that general order flow. Therefore, they've already spent the money to go get the stops. They're not going to spend the money to, again, go take out the stops. And that's why putting a stop beyond the actual stop run candle is the safest place to locate your stop. Now, getting into today, or a couple of days, we'll go over one last thing, and then we'll get into member questions here. I want to get into the daily market review or kind of what we covered a day or so ago. And what we had is last, let's see, 28th is Friday, so this was Thursday. Okay, so this was Thursday. So Wednesday we had the third push down. I'll get into the questions here in a little bit. Wednesday we had the completion of the third push down. So during this time here, this is again the Asian session, during this block here, I'm going to get rid of that block. So during this time, that's your Asian session. So when we came out of that, basically right at this point was where I was doing the Okay, so right at basically this point is where I was doing the daily market review. That's where I was this is where I was starting to do the review. And so with that in mind, we'll discuss some key points here. One of the things that we can do once we've finished a cycle is we call that, level 3 type accumulation, because positions are accumulated during this time, and that's why we go into a time where we trade high probability manipulation points to either side. And that's one of the things that opens up during this time. So what I said is, in the review, essentially it boils down to something very simple. We completed the previous trend, and therefore in the review we were expecting the first push to the upside. We were expecting the first push. That's what we said in the review. And in the review, what I said was I would look for the market to come down and create the stop run or the stop run bottoming formation on the previous day's lows, because pretty basic fact, if anybody is long from a swing trading perspective or even from a short-term trader's perspective, if they were entering long, and they like to leave a wider stop, coming down and taking out those lows is going to take out any stop for anybody that's long, especially those that are long on a short-term basis. So that's why I really wanted to see that low taken out. As the market closed, or as we were doing the review up here at this point, I mentioned that from the current point we were at to those lows, there was about 55 pips. And so what I said in the daily market review was, don't let those pips go to waste. If we see manipulation, or if we see the test really into 2,900, and we see the rejection from 2,900, we should be trading that manipulation around that, again, that high probability manipulation point. Now, why is that level the key level? Well, that level is the key level for 3 reasons that are right off the bat. Number one, any stops that were just above the Asian session highs right here would be taken out. Anybody that was putting their stop above the 200 or trading the breakout of the 200 would be getting triggered. And anybody just above or right at the 2,900 level would be getting triggered as well. Therefore, there's a massing of orders in and around that point for a lot of very basic reasons. And again, we teach and we cover all the basic criteria we're going to look for. We try and jam in as much information as we can, but we do cover what we should be looking for, what makes it a high probability level. The basic question you can ask yourself is, what is the average retail trader going to do? And you hit the major strategies, and that's how you can assess where the levels are. And so what did we have here again? This is a trade, I'll cover a trade a member took specifically, but what they did is they waited for the rejection off that level. So they waited for the market to prove that, yes, they were getting rejection from that high probability manipulation zone. They waited for the confirming candle down. Now you notice here the 3rd candle never gave a pullback. 4th candle, 5th candle, 6th candle, 7th candle. It took till the 8th candle to give a pullback. Now typically I won't take it that late in the entry. But one of the things that we know is that if smart money wants to drive the market up almost with a certainty, and this is why we can, every day in the daily market review, we can map out not only their direction with a high degree of certainty, but we can map out exactly the points they're going to start from. And it's not a crystal, as I said in the beginning, it's not a crystal ball. It's the fact that we know they have a massive demand, and therefore they are consistently going to drive the market into areas of mass supply. That's a very consistent pattern. They have no choice but to follow that pattern if they want to enter the trade. If they want to buy, somebody has to be willing to sell it to them. If they want to sell, they have to find somebody to buy it from them. Therefore, they will never change. That will always be the way they enter positions as well as exit positions. And it can't change because that is the way they have to trade. They have to find areas of high probability. They have to find those high probability manipulation areas and then trade through those points before trading off in their ultimate direction. And that was the entire principle here. If we knew they were going to come up, if we were expecting the reversal to the upside based on the smart money trend, then one thing that we knew was that they were at some point going to come down and take out the stops to the low side. So in order for them to do that, they were going to have to drive the market down into that point. That's why that's why those that did take this trade took the short, because they knew at some point smart money was going to drive it into these lows. That's why during the room this day, we didn't take a trade. And one thing I said at the end of the room was look for the manipulation into this point, because that is the highest probability point. They come down, they take out the stops, and then they run to the upside from there. The pattern of them hitting stops before turning is so common. You go out to the hourly chart, and just a beautiful hourly stop run candle here. You come over to the Aussie. This is one of the things that I wanted to also point out. I'm just going to do a quick shoot through here on a couple charts, and I will make this bigger. This is a great trade we're talking about in the room. I personally didn't catch it because it didn't give me the pullback I wanted. All right, here we go. So let me zoom out here a bit. And again, I'll get to these questions in just a second. Scroll back a bit here. We go back, we look at the way this market responds. This was something during Aussie employment change. On this broker, it doesn't quite break the stops. On MB, it broke it by a few tenths of a pip. But before they drive the market up, they create the false push to the downside. That's what started this entire trend on the hourly chart. So we zoom out here. This is what started this entire trend to the upside. Now, if you notice, what starts each of these moves up here? Well, let's zoom into the 15-minute chart and look at it. You notice here that we broke below the established low. We come down, retest for that clear bottoming formation, and then run off from that point. As we continue to move on here, what do we see again? We see them come down, break below the previous lows by about half a pip or a pip further, and then run off to the upside from that point. What do we see when they turn the price at the highs? We see them break the previous high and then run down from that point. So when we start to add all these facts together, it gives us an extremely clear picture of what they're typically going to do. Are we going to have a clear picture every day? Of course not. There's times where it's very rare, but I think I can remember one or two occasions where I'll come into a daily market review and say, hey guys, I'm not going to be trading today because I don't like where we're at with either the current market cycle. I don't like the high probability manipulation points, or I don't like one thing or the other. In general, however, we do have very clear entry criteria that presents itself every day. All right, let me look at these questions. We're gonna get into questions now, guys. I've pretty well covered what I want to cover, and so hold off 1 second. Let me read through these questions. Okay, Praven says, and I hope I pronounced that right. Should these candles come in succession? In other words, you have one reversal candle, but the next candle does not close below that. The third candle comes down again, but does not close below the low. The fourth candle is the reversal again. And the fifth candle comes down, then is no pullback. I'm referring to the 1 hour chart on Tuesday, trading the euro. So 1 hour chart on Tuesday. Okay. See where Tuesday was. Friday. Okay. So you're referring to these candles up. Let me zoom in a little bit. You're referring to these candles up here. Let the chart catch up here. These candles right here. Praven. Okay. So what I'm assuming you were looking at is you were looking at trading a 1 hour stop run. One of the basic criteria that you can look for, and this is what we we term as a reversal leg stop run, or some people call it railroad tracks. And so if you were to combine these two candles here, what type of candle would you have? You'd essentially have a candle that looked like, I'm going to do a poor drawing of this, but you'd have a candle that looked like this. You'd have a big, essentially a large pin bar if you combine those two candles. And that's why the reversal legs or the railroad tracks, in this case, we still consider that a stop run because it's breaking through a level and then getting rejected right back below that. So you were looking to trade the hourly stop run. What I consider in railroad track, or in a situation where you have essentially railroad tracks, what I look for is I look at the first candle as, I look for the candle here, the candle coming into the resistance as the first candle, and I call the candle that is engulfing it and essentially completing the railroad tracks, I call that the second candle. Therefore, the entry is on the third candle pullback. Fourth candle gave you a slightly deeper pullback. No, that second candle did not close below the body of that reversal candle, but railroad tracks are a little bit different in the sense that I will, once the railroad tracks are set or the reversal legs are set, I use the third candle, which was this small bodied candle, to take the entry, and I take the entry as it pulls back and it hits the 50% point of those candles. So if those candles were, let's see here, 29 pips, I would want to see about a 15 pip pullback, and that candle pulled back about 14, 15 pips right in that area, 14 or so pips. Next candle pulled back in the 15 pip area. Hopefully that makes sense. Okay. We do have, I've just, and I'll probably end up loading it, putting that up this weekend, but we have additional videos that's, I'm not sure if you remember or not, but we do have, or will, coming up Sunday or Monday, have the 1 hour stop run video. It's just a supporting video for the course. We have some supporting videos for the course. But anyways, that's a basic principle. We'll cover a bit more in that video too. Okay, so moving on here to the next question. Let me see here. Praven, you're asking, your second question is there, would you agree that they've made a first push up in the euro when the market opens Sunday, Monday, we have 2 more cycles up? The way I'm going to be trading that is I'm going to be trading it with an open mind because we've retraced almost the entire first push. So what that means is it opens the door to possibly a failed push. If there's a failed push, then we're going to see continuation down. So it's going to take, it's not as straightforward as some of the, in other words, we're going to have to stay open-minded and trade both sides of the manipulation during the high probability times, which opens up, in my opinion, I kind of like those days more because they open up a bit more possibility. I don't trade chart patterns, Corey, as far as head and shoulders are concerned. If it's, if it lines up with everything else and it's a high probability manipulation area and it's seeing a stop run through it and we're getting a retest, which is essentially the second shoulder, if you will, then I'll consider it. But if it's not lined up with everything else, I'm not looking at it. All right, I generally don't look at it. I guess I'll say it that way. How do you factor in, Walter? How do you factor in a news release, let's say at 8:30 Eastern for the euro or the dollar? Most U.S. news releases do not move the market. The news releases that move the market are Fed statements nowadays. If you guys notice, the what's that? The red indicators or the red news releases that you'll see on Forex Factory don't move the market out of the States anymore. News has become much less important. If we do have news, we do watch it during that session. And typically, the best way to trade news is they use news to create stop runs. So they'll use the news to drive the market past a previous high or past a previous low, and then they reject the price. So look for news to create stop runs, and that is the best way, in my opinion, to use news during the New York session. The UK is a little bit different. There's some more news out of the UK that does move the market that you got to really understand the news to trade against it on a stop run. Okay, moving on. On September 27th, uptrend black line, there is no pullback candle. Do you have an entry strategy for this trade, or you missed this trade? I'm assuming you're meaning the euro there, Ken, and we'll go over to the 27th. That was an hourly candle. Let me go into the 15-minute. The 15-minute did not give a pullback either. This is one of the things that we talked about in the review going into Friday. That was a trade that I personally missed. I did not catch that trade because we did not have a pullback. So yes, that would be a trade that I miss. Also, one of the things I want to say is the daily market review, or the live training sessions that we do on Tuesday and Thursday, there's a lot of people that couldn't make them. So what we've done is we've actually started to record all those training sessions, and we have an entire backup of the training sessions, and we record every session. So there's every part of the service can be used, whether somebody can actually be there or not. Again, the daily market review is a video as well. Yeah, once you understand, Danny, you're saying, unfortunately, I cannot make the recommended times. I've been using limit orders at high probability points, but have been unsuccessful. Any pointers that can help in my situation? Well, you have to really have a complete understanding of the smart money strategy. If you number one, what can help you is take trades at the highest or number one, take trades in the direction of the overall smart money cycle. So you need to understand cycle, go through the information, understand what makes a push, what comprises a push. Is this a first push? Is it a second push? So you need to, number one, understand what direction of the cycle you're in. Number two, when you're looking at trading with pending orders, you should be only because you're outside of the trading times you want to be at, you really don't want to be trading with pending orders during the New York session. I don't want to say it like that as definite as that, but your best time to use pending orders is if you're going to place them at 10 o'clock at night, 11 o'clock at night, 12 o'clock at night Eastern time in the U.S. And that's a couple hours before London opens up. The reason for that is just tends to be a bit more predictable, and the high probability manipulation points tend to be a bit better as well. So if you're going to place pendings, that is, this is specific information just for pendings if you're not there, I recommend doing it for, more for the London session. And even if you live in the States, you can still do that because you don't have to place your trades till 11, 12 o'clock at night or 10 o'clock. Another tip is select deep manipulation points. If you see two high probability areas, only trade off the deeper one. Yes, that's going to mean you're going to miss some trades, but it's going to keep you out of a lot of bad trades. Another thing is your risk reward. I can't stress to you guys the importance of risk reward. Risk reward will be, I can promise you, it'll be the single determining factor as to whether you're a profitable trader or not. The reason I say that is it's been that way with every trader I know. Any successful trader always has a high risk to the high reward as compared to the risk. So with trading is such a mental game. If you don't believe you can do it, I can promise you can't do it, because you will defeat yourself over and over if you don't have the belief that you can do it. And so where that belief stems from is it stems from the basic thought of knowing that something is attainable. That's why risk reward is so important, because you can look at the market this way, and this is what I recommend for all our members, anybody that we talk to. I always say set something that's attainable so that you can start to see it in your mind's eye that, hey, this is truly attainable. And the best way to do that is set the goal of winning 50% of the time. And this is going to, people that have been brainwashed by everybody else that's pitching, oceanfront property in Montana. It may not sound like something that's good, but think about this for a second. Let's say that you do set the goal of winning 50% of the time, and you do it with a 2-to-1 risk reward on all your trades. Run the math on that sometime and do it with 1 or 2% risk on a very, the size account that you would be trading with, and you'll be shocked at the percentage gain that you could have with a trade like that, or with an account like that, just taking 3 or 4 trades in a week. So if you set yourself these very low parameters, they become attainable in your mind. Once it becomes attainable in your mind, you're more likely to achieve success, and that's why we strongly recommend that people do that, because that is going to be absolutely critical to whether or not you're actually able to attain success. And when it comes to trading pending orders, if you look at it from that approach, it's going to be much more attainable for you. All right. Andrew, how to become partners with Chad? I've known Chad for quite a while. Actually, Chad was, I met Chad when he actually lived in Michigan, and we have always been friends, and we trade the same way, we have the same belief, and it just got to the point where we work well together and work towards the same thing. So it's just a good fit for both of us. But I've known Chad for 5 or 6 years, something like that. Okay. Are some days better to trade than other days? Just Sunday, Monday trading on the same probabilities as other days of the week? Tuesday, Wednesday, Thursday tend to be your higher volume days, and Friday is getting into the point where you're seeing a lot of really good moves Friday. Sunday and Monday tend to be a little bit less predictable, but it's not bad enough to where I wouldn't trade those days. But yes, Tuesday, Wednesday, Thursday, Friday tend to be better days. Okay. Abdul, you wrote, what do I mean by tight stop? Was answered by Sean, 20 pips. How can we use correlation before the market actually moves? Good question, Frank. The way we use correlation to understand what we're going to be looking for is we apply the same basic rules to, let's just say we're looking at the euro pound. So if the euro pound has, let's kind of see where we're at. Okay, so let's just take this for example. Let's say the market is starting, I'm not going to get too far into analyzing the euro pound, but let's just say we've had we do have a very clear stop run of those highs that was immediately rejected. Whenever you see the price start from a stop run, very clear indication that smart money is driving that price. So more than likely, we should expect the second push to the downside. Eventually next week, the market might open, might retrace back up a bit, but ultimately, I would like to see the second push down. So what does that mean? If the euro pound is going down, that means that we're going to see euro weakness and pound strength. So keeping that in mind, we'll go back over to the euro, and let's say that both the euro and the pound are giving us a setup off of a stop run of the lows. Let's say they both come down and they create a stop run of the previous lows, and we're looking to trade them back to the upside, and we're saying, okay, which of those pairs should I trade? Should I take the euro long or the pound long? They're both giving the exact same setup. They're both giving a stop run of the lows. Should I take the euro or the pound? Well, we just discussed that the euro pound has made its first push down. If it's going to make its second push to the downside, what that's going to mean is that we're going to see, during the second push, we're going to see euro weakness and pound strength. Therefore, if both the euro dollar and the pound dollar are setting up to go long, we know that based on what the euro pound is showing, the euro is going to be weaker than the pound. Therefore, that would guide us to take the pound instead of the euro. So
we're going to apply the same rules, the same smart money strategy we do to the euro pound. Understand what cycle we're in with the euro pound. Maybe even wait for the euro pound to set up to move in that direction of that cycle. Once it does, and it starts in that case to move down, if it does continue to move down, well, your best option is going to be buying, the better option if you have an opportunity to buy both the pound and the euro, the better option would be to buy the pound. And contrary to that, if both pairs set up to go short, you'd be better off selling the euro, excuse me. Hopefully that makes sense. Well, yeah, Mike, that you say just join, make the effort. Every daily video is like an hour in college level course. Well, one thing I do want to say is we're definitely not for everybody. We give more support than anybody out there, and it's daily support. In the daily market review, I tell you which direction the market's going and the exact price points I expect it to go from. But with that being said, we're not for everybody. If you're not willing to put in the work, then we're definitely not for you. You're not going to succeed with us. I can promise you, you're going to, if you think that you can just read a course and then succeed with it, you're still caught up in the fact that somebody's trying, there's oceanfront property in Montana, and there's not. So if you're still in that belief, that there's a magic indicator out there that's going to make you successful, or an EA that's going to make you a millionaire, or there's some get-rich-quick trading strategy out there, there's not. There's basic fundamental rules about how the banks move the Forex market. Those basic rules allow us to track the footprint in the sand that the banks leave. That basic principle is something that everybody can learn and attain with time. Not even an extremely long period of time, but it will take some work. If you're not willing to put in the work, we're definitely not the service for you. The room runs from 3 to 4 a.m. Eastern and 9 to 10 a.m. Eastern. We say it only runs an hour, but generally Chad's session is 2 hours, and generally mine runs an hour and a half. Thanks, Corey. Glad you like it. Sean, thank you. Here's a testimonial. Miles, I appreciate it. Miles says, here's a testimonial. I've been a full member for a month, and I've learned more than I had elsewhere in 12 months. And you guys are definitely teaching, and definitely for a fixed price. I appreciate that, Miles. Glad you're enjoying the service, and really glad that you're actually learning something. Corey, very true. You get in what you put out, and if you guys are willing to put forth the effort, we're there every single day to give you the effort right back. Dave, glad you're liking it. Thanks, Terry. Appreciate it. Mike, that means a lot. Appreciate it. Mike said I lost 20K in 2 years. On my first try with a reputable vendor, it was hard to trust anyone again. I like Sterling Chad. I don't regret one penny yet. That means a lot to us, Mike, so we appreciate it. Thanks, Irene. Charles, how are the gray areas generated? The gray areas are generated with a very simple indicator that we have on the charts. Now, that indicator, it's just something we have in the back end for members. It's a very, personally, I'm not really, it's kind of grown on me. The way it originally started is I had a member that said, hey, Sterling, it's hard to follow your charts in the daily market review. Will you put on this indicator? And they gave us an indicator and said, will you put on this indicator on your charts so that we can follow you a little bit better? And I hate anything on my charts, but it made it easier for everybody. Everybody loved it. And then we had our own indicator made, and essentially that's that as far as the blocks are concerned. And it blocks out, it's kind of grown on me now. It actually makes it really easy to scroll back and look at price while you're scrolling back on a faster time. Personally, I use, especially lately, I've been using a smaller risk around 1%, and the reason for that is I tend to find that I just am more comfortable with that, especially personally, I'm working through a little mental barrier. And, for me, that the safety factor, you tend to trade a bit better. And so, I personally recommend around 1% risk. Now, if you have a, $1,000 account, you may want to use a little bit higher risk, 2%. So I generally move my stop. I never move my stop to break even. Chris, you're asking, do you have a question or you have a question about when to move the stop to break even? What I recommend is not moving the stop to break, or what I personally use, I do is not move the stop till it hits at least plus 30. Now, the reason for that, it's a good general rule of thumb, is a lot of times you'll see the reversal candle, you'll see the confirming candle, and a lot of people are taking a trade right at the end of that candle, and you get a 15 or 17, 20 pip pullback. And what that does is that pullback, on the third or fourth candle is enough to stop people out that use a 20 pip stop. So a lot of times you'll get in profit 20, 22 pips, and that's where the market makes the pullback. So it hits all those people that get in to 20 pips profit and move their stop to break even. That's why it tends to be a bit better once you move it at around the plus 30 mark. I generally trade from 8 to 11. I like trades that happen later in the session. There's times I take trades outside that session. I'm going to cover £1 trade here because I think that's was a nice trade as well. So I'm going to cover that here in a little bit. I want to get through these questions real quick. When it comes to specific market questions, guys, we're going to, if you guys want to email us, we'll answer market questions, or you can ask them in the members area. But when it comes to right now, I'd rather not answer questions that were specifically about this because it's very narrow. So I want to answer the broad-based questions here. How many pips should we look for on one push? Typically, we like to see the market making a 90 pip push. That's a good mark that smart money has actually been moving the price. So it's one good thing that's one of the reasons why we say make sure you're getting that 2-to-1 risk reward. And that's why we're selective with the trades, because if you've truly identified when smart money is moving or taking an entry, you're not going to see a 10 pip move. You're not going to see a 20, 30 pip move. You're going to see a 70, 80, 100, 110 pip move, because it takes them a while to enter the market. And additionally, it takes them a while to exit the market. And that's why you're not going to see just a shallow 20, 30 pip move, and hence why we want to see that bare minimum 2-to-1 risk reward. I've been around this market, Chris, for a long time. Chris, you're asking, as a relative beginner, I'm concentrating on 3 pairs, euro, dollar, euro, pound, and pound dollars. Does it seem okay to you? Well, I'm on the other spectrum. I've been around for a long time, and I pretty well only trade the euro dollar, the euro pound, and the euro, or the pound dollar. And really, I don't trade the euro pound. I use it as correlation. I pretty well 95% of the time take trades on just the euro dollar and the pound dollar. Mark, you ask, what do you mean when you say not willing to put in the work? What kind of work does your course require? Well, most people are happy to sit down for hours a day and spend hours a day watching the TV. But if somebody isn't willing to put in the work to watch the 15-minute daily market review, or if you're not able to attend the training sessions, and we now record those training sessions, if you're not willing to put in the work to sit down and listen to those training sessions, maybe not even listen to all of them, maybe just one a week. So if you're not willing to put in a very basic amount of work, it's not like it takes mountains of time and hours, but it does take, looking at the review. There's 15 minutes a day, maybe looking back through the charts, seeing what setups did occur, asking some questions on those setups. Some very basic things to further your education. The more questions you ask, the more you'll learn, and the faster you'll learn. Bare minimum, though, watching the daily market review. That's 15 minutes a day. You're going to learn. That is the most valuable part of the service. You can learn the strategy all you want, but if you don't understand the application of it, it's going to be difficult. And the daily market review, and the daily market review gives that forward-looking application. What's so good about the daily market review, especially for new people and those that are just learning the strategy, is that I give you the direction for the following day. Not only do I give you the direction for the following day, but I give you the exact price points I'm looking to trade from. And I tell you exactly what I want to see at those exact price points. So when it doesn't set up at those price points, you don't take the trade. When it does set up with those price points, you know in advance exactly where to look. So I think there's a huge advantage to the daily market reviews, and it's why I think it's probably the most valuable part of the course, even more so than the live room. Charlie, I've taken Steve's course. Great learning experience, but where were you guys before I laid out the big bucks? We've had that question 1,000 times. So we've always been around. I mean, look at the stop run video. We were teaching manipulation years ago, long before he was teaching on the web, and that's one of the things I think that's misunderstood. The bank manipulation in the form of a stop run, in the form of high probability manipulation areas, is something we've been teaching for quite a while. The stop run video, which was put out long after I actually started teaching the stop run or the manipulation at high probability areas, that was put out, I believe, in March of 2010, and I was teaching that in the Diamonds room before that, which was 4 years ago or so. It's just we get that question a lot. It's unfortunate, but at least you got put on the course of learning what smart money's doing, so you can be thankful for that, Charlie. And you got the basics of it, so you can be happy with that. Sterling, what do you recommend? What is the best way to educate us in smart money trading? Go through the course a lot of times, and then the back end is set up with a funnel for everybody that comes in. You go through the course again, maybe a couple days later, and I recommend going through the course 2 or 3 times, and do that over the course of 2 weeks. So you go over the course once, and then what I recommend doing is going through the daily market reviews. Go back a couple months and go through all the daily market reviews that you can. Those daily market reviews show the application of it. I talk about what happened the previous day. I talk about exactly what I expect the following day. And then when the following day's review comes around, I say, okay, this is what we're looking for yesterday, but this is actually what happened. So I compare it. It's a very good learning tool. And then what we have is we have the live room. The live room allows opportunity to see these trades taken live when the opportunity does present itself. We are not a trade calling service, but I will call my trades live when they do present themselves. It also allows the ability for members to ask questions in real time and get this type of feedback on a weekly basis. For those that can't make it, we record these sessions. You can watch them anytime you want, whenever your time allows. So that funnel of asking questions, and then again, the Forex forum allows you to take a picture of a chart, post it. Hey, this is a trade I took. It went good or it went bad. What did I do wrong? What did I do right? So there's a ton of different avenues, and what I always tell new members is you got to give it some time. You're not going to learn everything in 2 weeks. It's just not going to happen. You'll have a very good base after a week. After 2 weeks, you'll notice that you have an extremely good base. After 3 weeks, it'll really start to click. But what I really notice in members is that it takes about a month. It takes about 2 months, and for everybody, it's different. But it tends to come together very quickly. Once you get the gist of it, you'll start seeing, okay, this is how smart money runs the price. This is what they're going to do. And you'll develop what I term as that kind of that sixth sense, where you know where they're going to go with the orders, a high probability amount of, with a high degree of certainty, the majority of the time. And are we wrong? Of course we are. I have losing trades, and and that'll never change. Danny, thanks Sterling for the advice on pending orders. I appreciate the work you put in for members. No problem, Danny. Glad you like it. Brian, yes, we are recording it, and hopefully we'll have that posted early next week. Smart money, good marketing, teaching 100% win rate. Never saw any proof 50 lot trades. Well, you know, if somebody's teaching 100% win rate, you should the red flag should immediately go up. If somebody's teaching 90% win rate, the red flag should immediately go up. It's setting that goal that you'll never achieve, and if you realize you can't achieve it, it's going to hurt your trading tremendously. You got to set the realistic goal. You set the realistic goal, you can go from there. Until you have the realistic goal, it's ridiculous, you know, to even conceive of trading profitably. You know, the biggest part of the service is the support, and it's the daily support, because you know, the daily support is really, and maybe we can get some people that are members and some feedback on it, but the feedback you know, from members is, in general, that the support is the most valuable part. And I'm sure you guys have all experienced this on your own. You bought something, whatever it is, and if the support isn't there, if you don't get an answer emailed the day you send it, if you don't get questions answered fast, if you don't have, you know, access, it just doesn't work. Even if the system is good, or whatever it is good, the support is always the most valuable part, and it can make or break whatever it is. And that's really, with us, it's probably the most valuable part as well. What time do we do the review? We do the review at around midnight. The reason for that is it's 2 hours before the London Open, and anybody that's trading the New York session, it really doesn't matter what time we do the review, because by the time you get up at 7 or so to start the trading day, or at 8 o'clock, whatever time you get up, you can go watch it then at any point. The reason I do it later in the day on Eastern time is because that gives me the clearest picture of the following day, and it allows me to give the most accurate information. And I want it, you know, really any time before 2, and it really doesn't matter when the video comes out, because if you trade London, as long as it's out before London, you can watch it. And then for New York traders, you're going to be sleeping, and then by the time you get up, the market review is always there. So makes it nice for both sessions. It depends on, there's a reason we don't post pie in the sky type results, and the reason for that is, my belief is that it's one thing for me to be able to trade profitably. It's another, you know, and it's one thing for Chad to be able to trade profitably. It's a totally different scenario for me to have the ability to teach you what I do, and then for you to succeed with the information that we present. It's going to rely on the information. It's going to rely on the way the information is conveyed, and the funnel of which it's conveyed, how it's conveyed. So really, with what we do, with what we have tried to do, is with taking that and giving it to people, is we've tried to set something up that allows for people to actually succeed with it. Because although in the live room I'd have 10 or 11 months a year where I was profitable, nobody could learn how to trade. And the reason for that is I created a bunch of self-reliant traders. And even if they didn't realize it, or even if they didn't admit they were self-reliant, there was always a portion that, and I'm sure this didn't apply to everybody, but for the vast majority, it just didn't facilitate learning, because they were able to rely on me or Chad every day. So with the current format, it just allows much better for learning. And I've had members that were with me for a long time when I just ran a live room, and then watched as we made the transition, and I saw those traders go from, what I would term as very reliant on Chad or I, to a proficient trader with themselves and with their own trading ability. Any recommendations, Karim, you're saying any recommendations on brokers? I've never tried that broker. The brokers I use are MB Trading as well as Alpara US. Chad, I know, uses FXDD, and he does use FXCM. I don't like FXCM. But you know, FXDD wasn't bad, and I personally love MB Trading. MB Trading is great. They've always been great to me. I don't recommend brokers because I don't want to be responsible if a broker screws you guys. I would feel horrible. I can just simply tell you who I have my money with and who I trust. And I trust MB Trading. They have the vast majority of my trading account, and they've always been good to me. They've always paid out. They have fairly tight spreads. Whenever their platform has crashed and I got screwed, or any one of 100 variations that could possibly happen to you, they've always taken care of me if it's been their fault. And I suspect that they would continue to do so for everybody else. I have no worry about high frequency trading, Erwin. The reason for that is the stops are always going to be in the same spot. Smart money is always going to drive the mass of the volume. Therefore, they're always going to have to go for the stops that are in the specific locations that people tend to place their stops. Because of that, the typical manipulation that we see today, we saw 5-10 years ago, and we're going to see 5-10 years from now. It doesn't change because the way smart money trades, they have to change. Glad you liked the daily market reviews, Miles. Appreciate that. Hey, there's no dumb question, Mike. The only dumb question is not asking a question. So really glad you liked the reviews. I appreciate the comment there. Why don't I like FXCM? Well, number one question, one time typing it will do. I'm just behind on the questions. And number two, I don't like FXCM because of all the vast stories about them slipping traders, 100 pip spreads during non-farm payroll, not fulfilling a take profit when it's hit, but always fulfilling a stop loss and then slipping through the stop loss. And I could go on and on and on with FXCM. And it's just my opinion. I also know people that have had success with them. Risk reward, we should start out with a good base of 2-to-1. One of the things that we posted was in that article that we posted Chad's track record, or a portion of his track record. The reason we selected that portion of the track record is because it had essentially a bad win-loss ratio. It had a win-loss ratio for that month or month and a half of about 50%, and it shows how profitable the account was over that time period. But there's a reason we selected that bad win-loss, is because it illustrates the point that your profitability will always depend on setting and maintaining a risk-reward of 2-to-1 or better. So and the great thing is the setups that we take allow for 2-to-1 on your risk reward. They allow for that higher risk reward because we're taking trades after we've identified manipulation from the banks. If we've identified them taking stops, we can almost be assured that they're going to give us a 70, 80, 90, 100 pip run beyond that point. That was Charles, to your question. Ken, I'm unbelievably thankful for everything I see in the free site. Look forward to the membership. No problem, Ken. Glad you like it. We'll see you on the inside there. Abdul, really glad you liked it. Glad to have you as well. Diego, yes, I have heard of Forex Yard. I don't have a whole lot of information on them. One thing I would recommend doing is going to forexpeacearmy.com and looking through the reviews there. Make sure you're subjective about the reviews, though. If they say something like, you know, this broker is crap because they widen their spreads to 20 pips in and around news, well, all brokers do that. So read the reviews and be subjective. A lot of the bad reviews are just bad traders that simply can't trade regardless, and they post things about a broker that every broker does. So read the reviews with some subjectivity. Yes, MB Trading, Fernando, is a ECN broker. They do not trade against you. They trade customer versus customer. So your order, you know, while it's in internal market, meaning you're trading customer versus customer, they're still not trading against you, which makes them an ECN broker. They're not trading against you, so they're technically not a bucket shop. Their reviews are great. They're probably the most valuable part, I think, and it just, you know, it gives you a direct insight into exactly what I'm thinking. And it's also awesome for anybody that's learning to trade the strategy or needs a little bit more guidance or maybe just wants a second opinion, because I'm so specific on those reviews. It's exactly the direction I'm looking to trade, exactly the price points I'm looking to trade from. ECN means Electronic Communication Network. Electronic Communication Network is a fancy way of saying they're going to route your order to live market. 2 to 5 or 8 to 11, Charles, is the time that we personally recommend. And the reason for that is you have new sessions coming on, and therefore this is the time where they put their general order flow through, which means this is the time where the best time to see manipulation and manipulation around those high probability points. Brian, I appreciate the kind words. Thank you very much, buddy. All right, guys, that's going to wrap it up for us. I really appreciate everybody showing. Thanks for coming out and showing up. I know a lot of people were, it's way late for you guys, so thanks for again showing up, and we will see everybody on the inside. And for all the members, we'll see you with the Sunday daily market review. We'll start to preview the following week and get prepared for the start of the week. So we'll see you guys then. All right, everyone, have a good night. Talk to you later.